Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Will.
And I'm Mortgage Mike.
All right, guys, we got a number of topics today to talk about. First, we got the 30-year fixed mortgage rates just hit 8% for the first time since 2000 as Treasury yields soar. Mortgage demand falls to the lowest level since 1995. Ouch, because interest rates near 8%. September home sales dropped to the lowest level since the foreclosure crisis. Another owie. And meet the homeowners giving up 4% mortgages and opting for cash-out refis. You don't say. That's going to be interesting. Let's get right in from the top, guys. So this article is coming from CNBC. The 30-year fixed mortgage rate just hit 8% for the first time since 2000 as Treasury yields soar. Those of you who are watching in the markets last week, the 10-year yield went and touched 5%, which the 10-year yield and 30-year fixed rate mortgages track with one another pretty consistently historically, and we saw 8% mortgage rates, guys. Now what the heck do we do?
Well, guys, how'd you feel? Were you even surprised seeing this?
I was not surprised actually seeing this. No, because, every week I'm looking at data, I'm looking at the information that's coming out, economic stuff, and the releases, and you go, okay, well, if this happens and there shows any sign of strength in the economy, no matter what sector it is anymore, it's going to put more pressure on the Fed. The 10-year yield goes up, mortgage rates follow suit.
That's right. Here we go. History in the making. They always say history always repeats itself. Well, here we go. The last time we saw this was back in 2007.
Yeah, so mortgage rates rose sharply, really kind of on time. I hate to even say that word. It's really
on time, huh, Andy?
Ill-timed, but on time because it tracked really well right there with the 10-year note. But obviously, you guys, this is going to spill over into there being some more psychological pressure on demand and buyer's psyche and even homeowner psyche. But we talked last week about on the show there are some solutions to the market. We'll come back to that in a minute. But I think this is really the unintended consequence of needing to raise rates on the Fed side in order to curb spending, but that spending curb is not curbing.
Yeah, it's not curbing. And as long as consumer spending keeps spending, we're going to continue to go into the higher interest rates. I wouldn't be surprised if we see the 9s, later down the line. As long as if people stop spending the money, then that's how we're going to kind of put this at ease. That's when we'll start seeing things kind of start going down. And that's some of the questions that I actually get asked from clients is, when are rates going to go down? And I tell them, have you been spending?
Yes.
Well, they're not going down anytime soon. So key factor here is let's not spend as much. Let's just try to be as frugal as we can during these times. So that way we don't show the Fed that we have all this money in our piggy banks we're able to spend.
Yeah, we're not doing a good job of showing it because last week retail sales came in far higher than expected. Yeah. So, what do you guys think? What direction are we going in next week?
Well, I'm glad you brought that up, Mikey. The retail sales number came in 3 times higher than projected, which something is awry. Either the number is some sort of false positive reading, or it is a skewed stat that is now going to then dip into the decision that the Fed has to make for what their dual mandate is. But the truth of that is spending is spending, but I think it's happening broadly by credit cards. You see credit card balance to the total of credit card balances exceeds $1 trillion. Just a couple months ago, we talked about that, and it's going to stay up there until people spend down their debt servicing, but they're not doing that either. So the retail sales is giving the evidence, or maybe the false evidence that, everything's fine in the economy, but people are basically spending against their cards, and now we're going to have a debt problem, or in addition to a mortgage rate issue, you have a debt problem, but that leads to a solution. And I've been saying this, I'm starting to say it like this, like home equity is going to be the new ATM for the next 12, 24, maybe even 36 months. Yeah, we've seen it before, but also I really honestly think home equity is going to be the ATM machine to help people get out of some really tough times.
No, absolutely. Again, here we go, history once again being repeated. We don't know what the Fed and how transparent they're being also, and how they're counting the spending. What they're not saying is that most consumers are actually utilizing their credit cards because, like you mentioned earlier, we're over that $1 trillion mark. We've never seen that before. So how can we spend, and why is consumer spending there? Is because we continue to give credit. So maybe banks got to stop giving so much credit to the consumer so we can see the slowdown in these things.
Yeah, it's a good point. And it's a pro and a con, right? If people need to spend on the things they need to spend on, demand is demand. Like I need certain household goods and things for my house because I've got a house of people. But if I don't have the cash for it, then the consumer's only other alternative is, okay, well, put on your credit card. Well, that just delays having to pay that later with whatever future money or income you're going to get to pay that off. So, 8% mortgage rates certainly aren't a help to people who are aspiring homeowners. And to people who already own a home, it's really not that big of an issue. The broader picture, I think, is the psychological impact that's going to make on consumer sentiment sentiment and home buyer sentiment and builder sentiment. I mean, look, we have this inventory issue, which we need builders to show up with more homes. But if builders are hesitant because, well, we don't know if people can qualify or we have an affordability issue, well, then I can make all the homes you want. But if people can't get in and the banks can't qualify them, I can't sell those homes.
It's like double whammy.
So, yeah, it's kind of like we're getting gridlocked here on a couple of different pressure points, and they're just like squeezing tighter on the left and then tighter on the right and then from above and below. And it's like, eventually something's going to have to like give, and there's going to have to be like a relief valve of some sort, but I don't really see clearly where that is yet.
Correct. You know what I love in this article? It says, these higher rates have caused mortgage demand to plummet as applications fell nearly 7% last week from the previous week. I'm like, yeah, okay. No kidding. What are these 8s going to look like now?
Yeah.
Again, the great thing, there's still people that are purchasing. There's still people that have to purchase or sell a home. I got a client that's coming from Virginia. He's PCSing here to beautiful San Diego,
nice.
And 32nd Street. So guess what he has to do? He's like, hey, I already was a homeowner here in Virginia. I saw that I made some money. Now I want to reinvest it in San Diego because I heard it's a great market. And so the great thing about that, Andy and Mike, is that 2-1 buy down or that 3-1 buy down that we're able to, negotiate the seller to pay for our new buyer, where it makes it seem like their interest rate's much lower for the first 12 months and then the next 12 months, et cetera. We could talk about that at a later time, but there's these tools that we're able to utilize in order to make things seem more affordable.
Yeah. And that's a great point, because it does come down to a matter of perspective, because it's kind of proportionately relative based on your scenario and situation. Some people are coming to San Diego because they're PCSing here. Some are leaving San Diego because they got orders to go somewhere else. And then other times it's life situations. Maybe someone's getting divorced and they got to sell the house, or they're getting married and they have 2 different places now that they're renting, and they're going to move into a home and they want to be homeowners when they're married. Like you're having a kid, you need more space. Like you're moving a senior into your home, or like a parent that needs care or something. There's always scenarios that are going to drive market activity, and right now that's probably going to be the bulk of what we see for the next remainder of 23 and certainly going into 2024.
You know what I like best though is when I purchased my home back in 1980, my interest rate was 9-10%. And then I actually went in there, Andy, and I went, what was the average home purchase at that time? And according to Freddie Mac,
can I guess?
Yes,
can
please. Drum roll.
1980?
Yes.
I'm going to say $30,000.
No, come on now. Go a little higher.
50.
No, man, come on now. So according to Freddie Mac, it was $112,000 average. And the average interest rate was 9.09%, more or less.
So what you're telling me is in 1980, you could have bought a house for you and your whole family for the same price as a Mercedes S-Class.
That's correct.
Wow.
Yeah. And you know what? If things continue this way, you might be just living in your S-Class.
Yeah.
No, I was just kidding.
Yeah. You know what I should have searched, though, was what was the medium income in San Diego during that time?
Yeah. Well, guys, you know what? So you talked about, builder sentiment and how the rates are going to psychologically affect people in this market. But I think one thing people should take advantage of is the builder sentiment, because right now, they say they're using a lot of buy downs to help customers afford these homes. And that's something they would use, quote unquote, sparingly in the past. And I've seen it firsthand that, it saves a lot of people, and that could be their ticket to get into their next home.
Yeah. No, I think you're right. I think builder incentive is going to be the way to go moving forward. There are going to be builders that still want to build because that's how they make money. That's how they employ themselves. It's how they build their company, have growth, and that's how people are going to get into homes, I think. So we will see more demand in the building area, I believe. Even with elevated rates, it does not kill the fact that people want to buy homes, and we have a housing shortage to begin with. So that has to equalize at some point. I think we're going to get a relief for that in 2024, and I already see things being moved behind the scenes to try to open up some housing to people that's currently not open to, and I think that's going to help us. So
yeah. And I'm going to say back in the day, it was very common for sellers and builders to give these types of incentives to help the people. Sometimes they wouldn't give extra incentives to do any repairs. I mean, you won't know this, Mikey, because you were probably getting burped at that time. You're so young. But these things were actually in existence. So I think we're going to start seeing more of these incentive seller concessions coming, in favor for the buyer.
Yeah. Well, let's move on to the next article today, guys. We got mortgage demand. This is also from CNBC. We got mortgage demand falls to the lowest level since 1995 as interest rates near 8%, but that was on the day that they actually ended up hitting 8%. So mortgage purchases applications have dropped. You have refinance applications, which have also dropped. And I don't want to just go down the path of it only dropping. I want to talk about some opportunities too, guys. So, even though the average contract for interest rates on 30-year fix are substantially higher now than they were a year or two ago, they're even higher than what the projected rate by this time was going to be. Remember, by this time of 2023, said, quarter four 2023, we'll probably see mortgage rates at 5.5%. We're clearly well beyond that, and it does not even look like we're returning anywhere close to that in the upcoming months and even maybe the next quarter. So yes, of course, applications are down. Yes, it's a byproduct of the rates. Yes, it's a byproduct of the inventory. But I want to talk about mortgage applications that are working right now. So let's talk about some of the scenarios that we're seeing here at the office with people where they're like, hey, I'm raising my hand. I need help, and I'm going to ask for help from you before it's too late.
Again, we're going to go back to that 3-1, 2-1 buy down, or even that 1-1 buy down. These are actually difference makers right now in today's market. Those are the things that are actually helping us out. So thank you, sellers, for considering helping buyers get into their home and making it affordable in the first 12 months of their payments. And the reason I say that is because if we're doing, the most common one is a 2-1 buy down. Let's just, for example, say the interest rate is 7.625. Well, for the first 12 months of their payment, their interest rate's going to go 2% lower, which will go down to 5.625, right? And then that's for 12 months. On the 13th payment, then it'll go to 6.625. And it's not an adjustable rate mortgage. This is a 30-year fix. And so this gives and encourages the consumer to go out there and say, I can do this.
Yeah. Well, can I just add something to that?
Please.
So when you're qualifying for this 3-2-1 buy down, do you have to qualify at the regular rate and then?
Well, that's a great question, Mikey. So yes, because it is considered a 30-year fix, you're going to qualify at the full rate, which is 7.625. All it is the 2-1 buy down is we're allocating the difference in payment of your interest rate of the 5.6 and the 7.6, whatever that difference in between of that payment is, we're allocating 12 months of those payments and put them into an escrow account so that the bank, as they make your payments, you really are making a payment based on 7.625. Right? So it's just money that's getting allocated in a different escrow account.
Yeah, that's a really good point, guys. Because if you're thinking of buying, you're not sure. Oh well, what's the horizon look like in the next year, 2, 3 years? This is a way you can do that where you're qualifying at the full amortized payment, but your actual monthly payment will be substantially lower than the market rate now on your way into homeownership. And to regurgitate another point that Memo had made on a previous show, when he bought his first house, that payment was a little bit tight in the beginning, but as he earned more money and paid down other debts over the course of time, that monthly payment became less compared to their income. Correct. And also when the market turned around and rates went down, he refinanced out of that. Yeah. So the mortgage payment ended up going into a lower fixed payment as the income also went up and gave a lot more margin and flexibility. So if you're looking at this from the short side of the conversation, that's also a disservice to yourself. Look at buying a home and real estate from the long view of what does it look like to be here for 10 years or maybe even 15 years. That might actually be the best thing for your life beyond what looks best on paper.
Correct. And hey, again, you qualify at that interest rate, and then that way we know you're able to maintain that payment. So we're not qualifying at the lesser rate, and that's why it's important that we have these rules in place so we don't see what happened back in 2008-9, the mortgage meltdown.
And something else I wanted to bring up too, specifically because here in San Diego, we have a lot of people who PCS and they get orders to come here to San Diego, and they intentionally buy a home here in San Diego. So especially for you military couples where you are both enlisted or you're both officers in the military, this would be good for you to consider coming to San Diego because those combined BAH allowances that you get for housing typically supersede the cost of what it takes to get a mortgage here in San Diego. But the minute you PCS out of San Diego, there's someone coming in right behind you that's going to need a place to rent and may not want to buy in San Diego. But their BAH will cover what the commensurate rent would be in town on the place that you own. So keep that into consideration if you're already in San Diego and you're married and you're enlisted, or if you are coming to San Diego soon and you have your VA eligibility. That is something you should consider when looking to get a home here in town.
Yeah. You know what's crazy about it? Even with the interest rates as high as they are, Mikey, we're still we are still seeing an increase in the sales price of homes. People are still snagging them. The other thing is that was just announced that Fannie Mae, Freddie Mac, now our new San Diego County limit has gone up from that 726 conforming loan limit to now 750. It used to be, I don't know if you remember that time, Andy, where we would see 417 every year for many years. It wouldn't even go up.
Yeah, 417,
And now since 2000, I want to say, I'm taking a guess here, don't quote me, but since 2012, we've been seeing those county loan limits increase every single year.
Yeah, it wasn't too long ago. It was like 589, 250 or something like that.
Yeah.
So, I mean, that's really far in the rearview mirror, even though it wasn't that far historically.
Yeah. And what that actually means to the normal consumer, conforming loan limit at 750, what it is the interest rate, it's more in your favor. Why? Because this kind of mortgage bond, when we do a mortgage, it'll become in the secondary market as a mortgage-backed security. So we're able to sell almost like if it's cash. There's so many investors that are willing to just to buy that out.
Yeah.
Once you go above that, now you're trying to work for look for a more aggressive investor that you can sell to.
Yeah. Well, there's going to be other things that come up too in the market where maybe you're watching the show today and you're like, oh, I already have a house, so I don't need to qualify to buy one. But we've recently been talking a lot more about using the home equity line of credit or the HE loan, also fixed second, in order to access cash, get yourself a line of credit, so you can do things such as consolidate debts if you have them. If you need to pay off some sort of other thing in your life, whether it's another loan somewhere else or a car or a motorhome, a boat, things like that you want to keep, or if you need to do a garage conversion or an ADU or add square footage to your house or remodel, maybe you have deferred maintenance you haven't done. It's going to be 30 or 40 grand to build a pool if you don't have one, like whatever it might be. That might be a good way for you. But you're like, hey, wait a minute, Andy, I thought rates are super high. Yes, but it's proportionate. I'm going to go back to the point I made earlier. It's relative, because if you have a 25% rate on your credit card, I'm pretty sure a home equity line of credit at 12 is going to be much more favorable. And even the loan amount on your home equity line of credit is going to be much smaller compared to your first loan that's fixed at 2.5 or 3 or 3.5. Yeah. So your blended rate effectively could still be 4.5 or 5 or 6 when you compare them all together and you put all that money in the same pot, but your out-of-pocket expenses are much lower. And the reason I'm emphasizing this today on the show, guys, is because I'm starting to hear things and talk to people in financial planning, taxes, and even some of my attorney friends where they're saying, hey, people are starting to have some struggles in their personal finances. Their budget isn't adding up, but they own a home. What are some of their choices? And so I know privately what's happening is people are having these challenges, but those conversations need to come out of the dark, out of the shadows, and come towards us so we can help you find solutions before you inadvertently put yourself in a position where maybe you can't qualify.
Absolutely. Yeah, fair enough. No, that's great advice. And again, there's a blended rate. Don't touch the first. If the rate's really low, you don't need to do that. The good thing is there's other options. And like you mentioned earlier, there's a HELOC, home equity line of credit. Works kind of similar like a credit card. It's an open-end loan. So you pay it off, you use it multiple times, then you have HE loan over here, like Mikey over here, HE loan, just buff guy, right? But you got options there. And so utilize those. And the cool thing about that is if your rate is 12%, and you're on the second and the first is at 2.25%. Well, there's a blended rate. It'll probably be like 4.25% altogether. Yeah. So when you do the math, it's a good way to do that. And especially if you're investing in your home or you're creating that ADU, guess what? That interest becomes a tax write-off for you. Again, I'm not a tax person. You'll have to find out what you're able to write off. But I know on a credit card for sure, I don't have that luxury of writing that interest off.
Will, you know what I was wondering?
Yes.
So I know you're talking about 2-1 buy downs and stuff, but would you ever recommend an ARM in any case to someone?
Yes, I do recommend ARMs. The only bad thing is ARMs are almost prehistoric right now, but absolutely an adjustable rate mortgage, I would certainly do that. If it's a 5-year or a 7-year and it gives you a better rate, 0.5% or more, than a 30-year fix, use that. Because we already know in another year, 2 years, we're going to refinance because rates have to come down, right? And there's a saying, what goes up
must come down.
That's it, and it's going to happen. It's just a matter of when.
Yeah, it's a good question, Mikey. I think there's a threshold for where that makes sense, again, on the timeline of how long someone's going to stay in the house and then what the market conditions are. Because also, with the ARM, you may not actually have to refinance out of it when it becomes adjustable. Here's why. When the Fed starts walking back down their Fed funds rate, that ARM that you got maybe at 6.5 becomes 6.25, becomes 6, becomes 5.75, becomes 5.5. Yeah. So you could actually find yourself in a situation where by getting the ARM today, you're at the perceivable top, and then over the course of time, it actually marches its way back down the steps because they're reducing interest rates. So it would be in your favor actually to have an ARM in that scenario. It is rare, but the bank has to be willing to play in that, and so does the borrower. So.
Correct.
All right, guys, let's move on to September home sales. Drop to the lowest level since the foreclosure crisis. I've been saying this for a long time, guys. I hate references to 2008, 9, even 2010, 2007, throw that whole like window of time in there, like anything that goes all the way back to that, there's some PTSD there for sure. That was a really rough market. I mean, the financial system was really sick, and a lot of bad things ended up cascading through the entire market. So this is very difficult to hear and talk about. But look, it's happening, guys. The inventory and the volume of homes on the market is substantially down from a year ago, which was down from the year prior to that. So now we have back-to-back declining years of home sales, and this all has to do with buyer sentiment.
That's it. I mean, these rates and the home prices is not helping. Again, I wanted to use an earlier analogy when home prices back in 1980 or so were 112,000 and the rate was 9%. It's very different when the median sales price in San Diego currently, they're saying it's 890,000. At a 7-8%, that's pretty wild.
Yeah, and Andy, I mean, you talk about, we had 2 back-to-back years of declining sales. Well, it's like, sure, the sales are declining, but then you look and the median home price is still up to almost 3% year over year. I mean, where's the disconnect happening?
Well, again, it's that core function of everything kind of being squeezed in from all sides. Yeah. You have the cost of borrowing money that's gone up at the same time. The inventory is low, that we refinanced half the planet, maybe even more half of the planet in 2020 and 2021.
Even the moon costs less.
So Brian mentions on the show all the time, golden handcuffs. People are just handcuffed to their house because they got a 2.5 or a 3 or whatever. I mean, dude, even if you called someone right now and said, hey, I got a 4.5% rate, they'd be like, oh my God, that's amazing. Well, when rates were 2.5, you tell them 4.5, they're like, hey, go. Hit the road, get out of here.
It's funny you bring that up because I remember when I worked with that old brokerage I was at, when I first started, the refinance wave was dying down. Yeah. But I remember I talked to this one guy and I called him. He's like, oh, I just refinanced. And, you try to go through the objection like, what they give you. And he's like, 1.9. Can you beat that? I'm like, well, have a good day.
Yeah. Good.
I can't believe that. That's crazy. That is crazy. I remember VA, even that was one of the lowest rates I got was 1.9%.
Yeah.
So, pretty crazy.
So from the article, guys, sales of previously owned homes dropped 2% in September from August to a seasonally adjusted annualized rate of 3.96 million units. Yeah. According to the National Association of Realtors, sales were 15.4% lower compared to September of 2022.
Again.
That's a pretty steep fall off.
Yeah, again, people, why do I sell? If I'm going to sell and I'm going to get this $400,000 or $500,000 in equity that I have in there, that's great, right? If I put all the down payment into this new home purchase with a higher interest rate, it's like my payment's still higher. Yeah. Where before it was way different. If I sold something and I put my 20-30% down, I may have a little bit of a higher payment, maybe like $200-$300, but not in the 1,000, you know what I mean, or 2,000. It's just crazy right now. It's just certain things are not making sense only because prior to rates were so low.
Mm-hmm. And part of this too, I mean, you get this from Lawrence Yun, NAR's chief economist, and he said this in the article himself, as has been the case throughout this year, limited inventory and low housing affordability continue to hamper home sales. The Federal Reserve simply cannot keep raising rates in light of softening inflation and weakening job gains. But again, this goes to the dual mandate of the Fed saying they need that. They need to restore price stability by quelling spending, cooling it down, and they need to see more unemployment. So it's like that has to happen. But here's what the effect of that is. First-time home buyers made up just 27% of sales when historically they make up 40%.
40, wow.
So that in and of itself, regardless of market conditions, regardless of everything else, this is the reflection of these impacts. 27% of sales are made by first-time home buyers now, compared to 40% historically. That's I think is drop. Maybe the underlying story of the whole thing is the first-time home buyer dream is becoming harder and harder to get, and there's fewer and fewer people getting it.
Yeah. Well, I don't know what else to keep going on this. This is just crazy. It's just history just repeating itself, but in a more difficult way.
So I'll ask you guys, let's make a prediction on the show. We'll go back and we'll see if this happens. So when October comes out and November comes out and December comes out, do you think it's going to stabilize or continue declining?
I'm going to say it's going to stabilizing what? Interest rates?
No, the volume of sales, it's been in decline.
Oh, it declined.
So September of last year versus September of this year, do you think October is going to be declining more or if it's going to be the same?
During these times, this is the season where people kind of just, hey, I want to start putting my Christmas lights on. I want to go ahead and prepare for Thanksgiving. They already send invitations out, so it's going to be a decline because we've seen it in the regular markets, things slow down. We see a lot of speed up like August, September. Well, actually, all the way from April, we see a big speed up. But I've always seen it in the, years in this industry, I've seen it more so like August, September. People are like, okay, that's it. I made up my mind. Let me go. Let me sell. Let me buy. You know, and so I'm gonna say there's a decline. Going down.
You, Mikey, you the same
decline.
thing?
Yep, decline.
Okay, yeah, I'm with you guys. Decline, unfortunately. I would love to see there be some sort of like flattening of it, but I do think it's a decline. Quarter four is traditionally all about the holidays, and people, again, to your point, Memo, August and September, people have moved into the neighborhood they need to move schools, get their kid on the right sports team, whatever that is, and then right before Halloween, it's kind of like that last push before, okay, I'm either going to get in or I'm not, and if I'm not, I'm going to wait till January anyway. So
yeah, again, we brought up the point where you go to Costco, it already has Christmas and everything. Like, are you kidding me? Are you really having to accelerate this time for us? Like,
it's okay. During December, you're going to see the swimsuits come out. So
and earlier we're talking about don't spend your money, but guess what's going to happen?
Everyone's going to be spending.
That's
crazy.
People are going to spend.
I know my wife Tanya's going to be like, what did you get me?
Yeah.
So, here we go.
Guys, coming in from Housing Wire, we have Meet the Homeowners giving up 4% mortgages and opting for cash out refinances. Like, the title totally grabbed me because I'm like, wait a minute, what do you mean cash out refinance?
Yeah.
But at the same time, I'm like, okay, wait a minute, I get it. It makes sense. We talked about this earlier in the show. People who got to make that move to make that move. So let's talk about some of this and why people are doing this. They had some examples in the article, but I mean, the cost of mortgages has obviously gone higher. But there are people where their situation requires they do a refinance. Let's talk about some of that right now.
Yeah, well, certain people have to do it, Andy. So it doesn't matter about the rate they currently have. It's a matter if am I going to be able to keep my property based on my property debt. Yeah, I was at a low interest rate. I have a client 2.75, VA. But guess what happened during that time afterwards? There was a daughter that had a car accident, and I don't know what happened, but he had to come up and pay for attorneys. I think maybe it was her fault. And so certain things happen in life that he incurred more debt after we had paid it all off when he got into this property. So fast forward a year later and change, your circumstances change. Certain things in your lifestyle change. And now it made sense for him to go out there and get a 7.25% interest rate because his blended rate, right, with the 2.75 and that's 25 and that other debt was much higher. So he was just like, I'm done. I need to pay this. Otherwise, what's going to go first is going to be my home. And so we want to make sure that it's not there. So there's certain circumstances and situations where a cash out refinance, a line of credit's going to work out, so it just depends.
Yeah, it just goes back to us always saying, it depends on your situation. So you literally just got to talk to someone. I mean, come on, even the article says at the bottom, cash out refis are not a fit for every borrower.
I like that. Good disclaimer.
Well, one of the things I wanted to talk about just from the I got my old man hat on, it says even though about 30% of mortgages applications are for refinances, nearly 90% of current mortgages are originations today. They're purchase loans. So, sorry, let me say that a little more clearly. So, typically, you'd have about 30% of mortgage applications that are refinances and about 70% that are purchases. But right now, 90% of mortgage originations are purchases. So, usually when we talk about forecasting as a mortgage company and looking at the future, you estimate that about 60 to 70% of your business will be purchases and 30 to 40% will be refinances. Now, back in 2021, more than $1.2 trillion of cash out refinancing was executed. Which I think that was the record high in 21. It was also the same year we had the record low interest rates, which has caused the golden handcuffs of people willing to stay. They don't refinance. But again, circumstances sometimes override what the budget looks like. And look, I'm going to be honest. I've had people in the past where back when I was doing originations, they literally just overspent themselves and they were really falling behind on their bills, but we were able to catch it right before they were becoming late. And the only thing they could do was convert that debt into a cash out refinance or home equity line of credit to pay off the consumer debt because the amount of outflow every month they're out of pocket was $5,000, $6,000. But by refinancing it into a mortgage, even if the rate looked ugly on paper, if their out of pocket was $5,000 and we reduced it to $4,000 total, they just saved out of pocket $1,000 a month and they were able to preserve their credit. Sometimes that is the best short-term solution, even if it looks unfavorable. Guess what? Your family doesn't need to know. Your neighbors don't need to know. You don't got to tell your coworkers that's the problem. That's what you guys have us for. We can help you solve some of these issues before you get into a situation where you have a mortgage late, you have consumer late, and then you can't even qualify for that type of help.
Yeah, exactly, Andy. Good point. Don't wait till it's too late. And it could be too late, And Mikey, you heard our conversation, a couple of days ago of a client. He's already pre-foreclosure. And it's the regular traditional type of financing is not going to be able to, it's not going to come to play. So don't wait till it's too late. Whoever you're looking at, whoever's in your area, just ask them for their advice and make sure that you're being transparent and sharing how they can actually really help you.
Yeah. And I want to bring up another story. Again, this is kind of off the camera. I talked to friends and people in business, and I had someone tell me recently, like, hey, I just took out $100,000 line of credit. I'm like, oh, okay, cool. What are you doing? Are you building something? Are you adding the house? Like, no. I just took it out because I wanted to have it available and accessible to me. And I was like, okay, explain to me more. Like, well, I think this is happening in the market. I think this is happening in the economy. This is what my job situation looks like right now. So while I have all these things in order, I figured I might as well qualify for it, and then I just have it there. So here's the thing. This is $100,000 line of credit, and it's not even being used. So he doesn't actually need it right now. But it was like this fortitude and this thought of, I better just do this now, because if I need it later and I can't access it, well, then I just shot myself in the foot.
Yeah.
So it was a total preemptive move.
So that's actually a great, I'm glad that's a great segue here. So it's not always to just pay debt off. You could always have it for a rainy day. As a matter of fact, it just gave me, you reminded me of my friend Dan. When rates were so low, he took $400,000 just to loan out at 20% to other people, because he's an investor, so he understands the power and leverage of money. So he's like, wait a minute, I'm gonna get this $400,000 at 2.25%. Like, why not? I'm gonna leverage my home. And we just hung up earlier this morning, and he was telling me he was in La Mesa working on his. They're building a couple ADUs over there.
Oh,
so
nice.
It's pretty cool.
Wow.
So yeah, you could always leverage it to make more money, because once you have that line of credit, if you're not using it, guess what? No payments.
Right.
You're not incurring anything.
No payments, not incurring any interest, and you have it all accessible to you whenever
so
you
I'm
want.
glad you brought up that point, because that's another form of how you could leverage your home to help you generate additional income.
Yeah.
On Tuesday, I have another client coming in. They're going to look into the possibilities, exploring options of converting their garage into a one-bedroom ADU, where they can rent it out for, $2,000 to $2,200. So leverage.
And here's something else I want to say. Like, if you're looking downfield a couple of years, let's say you have a 3% right now, and you're like, oh yeah, but a home equity line of credit is going to cost me 12%. Okay, that's fine for today. But if home values are going to stay and also go up over the perpetuity of time, whether it's a 3-year, 10-year, 20-year time frame, and rates come down again from the 7.5, 8s into the 5s, you could find yourself where you're refinancing that back into a 5 or 6% fixed rate, and along the way, you completely gave yourself a long runway for doing and fixing anything you needed to, and having accessibility to cash that your house honestly did the heavy lifting for. So meanwhile, as you're doing that, you're paying down your first. So your combination of your new revised balance on your first 5 years from now and your home equity line of credit is going to be in your favor when it comes to looking at your budget every single month. So keep that in mind, even though we're being mathy right now. That's why, look, these are the conversations we have with people. This is why we say, hey, call Memo, call Brian, call Mikey, get yourself in here to talk about what it is you need to figure out so we can actually give you some help.
Yeah, the other thing, this is what this article's covering anyways.
Yeah.
So we just kind of put real life examples into this.
Yeah, and I understand there's going to be some reluctance, and there's going to be some people like, it doesn't make sense. Here's the deal. Look, if it mathematically doesn't make sense, guess what? We can't do the loan anyways.
Yeah.
So you literally have nothing to lose by asking the question and going down the chart of curiosity and figuring it out. And if there is a solution for you, great, take it. If there's not, don't take it. If there's no deal, no deal.
And again, the reason why we use these real stories is just to give you some type of insight, give us, that information that we've learned, and just pass it forward, because we care. We care. We want to make sure that you guys, care for your other family members. If you hear for a certain situation, you're able to provide this information to them, and they can go and seek the proper help that they require.
Mm-hmm.
All right, guys. Well, let's go to the end here. Mikey, tell me about what was the best part of the show for you today? What did you like best?
I think the best part of the show was actually us finishing on this segment of, tapping into your home's equity and how to use it, because this could be a situation that a lot of people are actually in the next couple months. So I feel, consumers can actually take that away from today's episode.
Yeah.
Good. How about you, Memo?
Mine is just the realization that interest rates are going up, and they're going to continue going up because of consumer spending. I think it's, all the information the Fed's giving us is not all there, but it is what it is. I'm just glad that things are happening now, because now it's starting to give me at least that warm feeling that we're going to see the light at the end of the tunnel. So we need to just nip this in the butt, get the higher rates, and let's see rates come down.
Yeah.
Well, Well, you guys kind of said like exactly the perfect segue for me today, which is it's both. It's like I like that we can kind of read the tea leaves and see what's going on. And, you know, we're not in the business of making predictions, but we do have to be making predictions in order to be in business. And that is what the things that is important for us is looking at what the facts are. And you can say, oh, the numbers are lying. Okay, cool. Then they're liars. But if they're correct, they're correct. And also that helps us give a little bit of forecast and some insight, not only from our history of going through difficult markets in the past, but also seeing it right now for what it is, calling it what it is, and offering you solutions and help in the marketplace to use your home equity to your advantage in the situation, whether you need it or you just want to be prepared in advance. So you guys, this was an awesome conversation today. Thank you so much for joining me here. And we're going to be back with another show next week. Also, I'm going to tease it a little bit. Brian, you guys may not have seen it already, but Brian had emailed me a couple of different scenarios already in the market that people are actually winning in mortgage and real estate right now. And we're going to bring that to next week's show. So thank you all for tuning in. If you're watching on YouTube, make sure you subscribe to the channel, turn on notifications so you watch every episode. And same thing for Apple and Google Podcasts. Make sure you turn on direct download. So every single time we launch an episode, you hear about it first.
Yeah. And thank you for all the DMs that you guys have been sending us. Knowing what you guys want and what's helping you guys is really helping us giving you this information. So thank you so much for that.
All right, everybody. Thank you for watching, and we'll see you again next week.
Peace.